Hello everyone, and welcome back to the channel. Today we're going to be taking a look at how to calculate the intrinsic value of Apple, the largest publicly traded company in the world, sitting at $2.4 trillion at the time of this recording. You can do this for any company. It doesn't just have to be Apple. So before we dive into the calculations, let's take a quick look at what intrinsic value means. If you wish to skip ahead to the calculations, please check the timeline in the description below.
Well, intrinsic value is the number that if you were all knowing about the future and could predict all the cash that a business would give you between now and Judgment Day.
What he means between now and Judgment Day is how much money is the company going to make before it goes under.
Discounted at the proper discount rate.
When Buffett says discounted at the proper discount rate, he means what yearly percentage do you want the company to return to you on a yearly basis? Do you want 7% yearly returns, 10%, 15% yearly returns? You get the idea. This number is entirely up to you. Just make sure it's realistic.
That number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about.
When Buffett says this, he means at what price are you willing to buy the company today and have that cash laid out in order to have that cash be worth more years down the road.
Now, when you look at a stock, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments, it says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change, but the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future.
Let's figure out how much Apple would pay out in the future if you were to buy it today. There are two ways that one can go about calculating Apple's intrinsic value. So let's start off with number one, a discounted free cash flow calculations to see what we should be paying for Apple today based on our desired rate of returns. Here's the discounted free cash flow intrinsic value calculator. So as you can see, here are the metrics that we need to input. This is what's going to give us our present values for years 1 through 10. And then what we should be paying for the company as of today. We're going to be using market cap and not share price, but that's very easy to figure out. The three websites that I'm going to be using today are going to be Seeking Alpha, Yahoo Finance, and Macro Trends. Why am I using three? Because I like to double check my work and just make sure that one website has the same information as the other websites. Just basically triple checking my work here, because the last thing we want to do is make an assumption and use wrong information that's given to us, and then we lose our money. The biggest risk of investing is losing your money. So by doing this triple check, easily eliminate errors. So for the first pocket, we're going to be using the growth rates of Apple for the first 5 years. For this, no need to triple check. We're just going to go to Yahoo, click on analysis, scroll all the way down, right here in growth estimates. First years are going to be 8.3%, and then the next 5 years are going to be 8.89%. So we're going to go back here. I'm going to use a conservative 8%. Then for the rest of the years after 5, we're going to go back. This says it's 23.52%. That's impossible. So we're going to do a conservative 5% for the remaining years. Now, discount rate. As you remember from Warren Buffett, this is the rate at which we want our money to compound year over year. So for this, 10%. You can do 12%, you could do 7%. The difference is if you want a higher rate of return, you're obviously going to need to pay lower for the price of the company. If you want a desired, like let's say 7 rate of return, it's just going to mean that you're willing to pay more for the company, but get a less of a return. Terminal multiples. This is a multiple of free cash flow. So ideally for a low quality company, you're going to be paying 10 times free cash flow. And for a high company like Apple, we're willing to pay more money and willing to have a higher multiple of free cash flow. This is a top quality business. How do we know it's a top quality business? As of September 2nd, 2002, so this year, more Americans are using iPhones than Android phones for the first time ever, new report says. Major milestone for Apple. Just Apple products are obviously, it's the best of the best. So that's why we're willing to have a higher discounted free cash flow multiple. Now, 1 year free cash flows. So for this, we're just gonna go to macro trends. We're gonna go, actually, let's go back to Google. Apple, type it in. Apple 1 year free cash flow. Enter. First thing is gonna come up, macro trends. So right now we're at $111.44 billion. So we're gonna go here, $111.43 billion. Now we gotta double check. So we go to Yahoo, go up to financials, cash flows, scroll all the way down, trailing 12 months, 111.44. I think I put 4 for 3. So we're good on that estimate. Now, excess cash. How much money does Apple have on its balance sheets? Same thing again. Go to Seeking Alpha. We can go to valuation of the company. Scroll all the way down. Cash. We have $48.3 billion. So here, $48.3 billion. Now we double check. Let's go to statistics. All the way down. Balance sheet. Total cash on hand, $48.3 billion. You could do the same thing with this, and it'll find in the balance sheet. Of course, we could find it as well on the balance sheet. Cash on hand, $48.3 billion. You could also find that number, cash on hand, on all the financials of all these websites, and just going to the balance sheet. So now that we have that out of the way, we're finally starting to get some numbers popped up. So at present value, we should be buying Apple when it gets to $2.066 billion, basically $2 trillion. When the company hits $2 trillion, if you believe these expectations to be true, well, mostly these up here, if it's gonna be growing at 8% a year and 5% thereafter, and you're willing to pay for this multiple, then you still need a ways for Apple to fall, because currently right now we're sitting at $2.144 trillion. So it needs to fall about like 20% or so. As you can see, Google has been going on a downward-ish trend. Just have to be patient. Now, let's say if you wanted even more of a discount rate. So let's say you want 12.5. It's rounding up to 13, but it's really 12.5 here. Then you need to pay even less for the company. So you'd have to wait till it's at $1.7 trillion. But let's say you didn't want it. You only wanted, you were good with 7%. Well, the company's fairly valued. Actually, it's undervalued right now. So for 7% return, you could definitely buy Apple because it's below its intrinsic value. Now for calculation number 2, we will be doing projected earnings per share calculations to estimate what we should be paying for Apple. Why am I incorporating this calculation? Because Apple is a buyback machine. Just take a look at this. On macro trends, if you go to the income statement, go all the way down, basic shares outstanding. If you go all the way back to 2012, they had 26 billion shares outstanding. Now forward 10 years, we're at 16.2 billion shares outstanding, meaning they just keep buying over and over and over their shares to decrease the amount of shares, which increases your ownership. Now, why is this important? So a quick example, if you have a pizza with 10 slices and you own 2 of those slices, you effectively own 20% of the entire pizza. Now, if that exact same size of pizza is now divided into 8 slices, but you still own 2 of those slices, you effectively own 25% of the pizza. So would you rather have 20% or 25% of Apple? Here we have the intrinsic value calculator for earnings per share. How this works is anything in blue, you input, and anything in green is an output that will spit out the calculations. So what we need to do for earnings per share is come here and type in your earnings per share for the current year. So for that, we'll go to macro trends, go to the financials, income statement, basic EPS, 6.15. So we type that in here, 6.15, enter. It's gonna populate all these numbers here, come up with our growth estimates. So the analysts, as from the calculation before, had 8% plus the 4.5 cash flow yield. So before we do our calculations on the growth rates, we gotta find out our start price. Apple, $138. So I see 100. I'm just gonna round up to 139. So we'll go here, 139, enter. So it's gonna give you a free cash flow yield of 4.42. I'm just gonna round up to 4.5 to make everything easier. So we'll do the 8 plus 4.5. It's gonna give us 1250 as a growth rate. Now it is 12.5. However, for here it's just rounding up in the figure. For the next 5 to 10 years, let's do a conservative growth rate of 9%. We want a discount rate of 10, and a terminal multiple of a good quality business will be 15. This will give us an intrinsic value of basically $100 for Apple. Basically, the lower the stock price goes for Apple, the more Apple will be able to buy shares and then in terms push this free cash flow yield up through earnings per share purchases. So this growth rate will actually increase when this decreases. Let's say the stock price was $20. Now this cash flow yield is 5.13. So this is gonna now be 13. Which pushes it a little bit higher. So you can safely buy the stock price just a bit higher. But for now, we'll put it back to 12.5. Now, if you want to be aggressive on your approach, say Apple's expanding into third world countries, they have a positive idea of what it is to own an Apple product. So we can be more aggressive with our approach. So let's say 60% growth rates for the first 5 years. Thereafter that, it's going to be 11. We want a discount rate of still 10%. And our terminal multiple, we're going to do 20. Very high. So based off these calculations, if you think this will happen, then it is undervalued, because right now stock price is 139, but it should be intrinsically worth 161 per share. Now, let's say we go into a very, very bad situation for Apple and their growth rates are stagnant. There's basically no growth. They're just going to grow based on their cash flow yield. So let's round it up to 5. Then the next after that would be 4%. Still want a 10% discount rate and a terminal multiple of 12 because we're lowering it. This is going to give us a price of $48 a share. The probability of this happening is extremely low. It's just worth pointing out what could happen if there is stagnant growth and there's only growth through earnings per share. So basically the revenue is not increasing, staying stagnant, but all their growth is coming from their free cash flow yield, which is the purchases of their outstanding shares. Now, if you add all the probability, so the probability of number one happening 70%, normal case scenario, probability of number two happening 20%, and the probability of worst case scenario is 1%. Like, we could even make this 5 here, and we'll reduce this to 5% chance this is happening. So your buy rating based off of these scenarios added up is $110. Given how everybody has been panicking the economy, getting to a price range of $110 is just $28 lower. We saw the lowest here, but I think this was about $30. Yeah, $30. And it seems like we're on our way back there again. Given how all the other companies, like now Apple is worth the same amount as Facebook, Google, and Amazon combined. This is the last standing pillar of all the stocks, and this is basically holding up the S&P 500 right now. And once this goes down, everything is just gonna go, the S&P is just gonna go way down. So if you wanna give yourself a margin of safety, please consider using this formula here to be very safe and wait until it gets to about the $100 or the $110 to start considering it. But these are all just based on estimates. If you have different outcomes for what you think Apple has the potential to do as an investment, then you can go ahead and change these numbers, what you think Apple is going to do in the future. I will leave links in the description below for access to both of these Excel documents. If you stuck around for this long, please make a note of hitting that like button and consider subscribing to the channel for more future content. If you have any questions, leave a comment below and I'll answer it. And until next time, Toro fam.